Hello everybody, this is Michael Jake, your local mentor. Got another video for you today. 7 exciting ways to go broke buying real estate with no money down. Okay, there's my radio announcer voice for you. So enough of that. We teach a lot of exciting things here on my channel, and a lot of these no money down tactics are great, but one thing you need to know of is things can go wrong, and this video is here to show you how they can go wrong, not to show you how to do it wrong, but more or less how to show you what not to do so you don't run into problems. One very smart gentleman once told me you can't make $10,000 in mortgage payments if you don't have $10,000 a month coming in. So what you need to factor is you need an exit strategy. How are you going to cover debt or seller financing, or whether it's taking over payments, lease options, no matter what strategy you're using, you need a way to offset that by generating income, and that's what we're going to talk about. So before we get going, please excuse me while I tangent for a minute and rant. Okay, if you have challenges with your credit, don't necessarily get into what we are talking about. Okay, there are ways you can kind of address that. Work with one of the best books I've ever read, A Really Basic Plan, never been out of print since 1936, is The Richest Man in Babylon. If you've got credit issues, buy the book. It'll take you a half an hour, read the book, apply it. My vids are really to teach people who are in the business of real estate, and it's there to teach them more techniques to do more deals and help. Yes, I said help other people solve a real estate problem they don't know how to deal with personally. So when I started wholesaling, I started building up some cash reserves, and even when I started doing no money down deals to hold properties, I still, my first several deals, in my offer, I would not offer to pay a payment until I found a subtenant. That was a way to offset my risk and help me, again, build my confidence to know, hey, here's a time frame I can fill one of these properties. And early on, the fewer properties you have, the more of an impact one is when you can't make a payment. So as you grow, as you get more properties, if you have more cash flow coming in, the impact of one vacancy is less relative. So again, think reserves, have reserve accounts. We'll cover more of that. Okay. Again, you need skills. You don't go off half-cocked and make a mess of things and give, ultimately you're just going to give the rest of us a bad name, okay? If you need A to Z info, if you need some hand-holding, check out and buy one of the courses I offer at localmentor.com. I'll give you the A to Z of whatever strategy on the course offers you, and you can get me personally there to guide you to success. Picture that. Wouldn't it be so nice? All right. How not to lose your assets buying no money down, okay? Ultimately, nobody ever went broke from buying a property no money down. Typically, people go broke because they can't make their monthly payments, meaning they got more outgo than they got income, or more month than the end of their money, something like that. Usually, people will look at properties from an inexperienced perspective, and they don't look at what all the real costs are. And over time, it may look like on any given month, oh, I've got $100 a month spread in this. What a great deal. But when you realize vacancy, maintenance, deferred items, marketing, things you need to spend in order to maintain that property or to fill that property actually cost money, and that $100 a month spread doesn't really cover all those expenses. And it may not be apparent when you only have 1 or 2 properties, but when you grow, basically those problems become multiplied and can become real problems, which kind of leads us to the next bullet point. You can't eat equity. And I can't tell you how many, you go to the real estate conference and you hear all the gurus on the stage, and they all got that story where, oh, I had $1 million worth of equity and I lost my butt because I couldn't make my monthly payments. You can have a lot of equity, but again, if you can't cover your outgoing expenses, you're going to go broke. It's just a matter of time. So equity may not be the most important factor when you're buying a property, especially if your plan is to hold it. If you want to flip something, yes, equity is very important, or at least the potential to create equity by adding value to the property, like doing a fix and flip or something like that. The most important factor is, can you make the payment? and your ability to make that payment over time is going to be very much dependent on what kind of income the property can generate. Okay, it's income minus expenses, and that just doesn't mean the mortgage payment. That's not the only expense. So more on that later. Vacancy. Herein lies one of the major expenses of any property. Having it go vacant. You may think your job is, I need to raise my rents. Oh, I'm not going to, get somebody to move. Ultimately, I was taught, price a property so whoever you're dealing with can't get a better deal elsewhere. Okay? And you will be surprised, people will move over $15 a month. It may cost them $4,000 to move, but they'll still move to save $15 a month. So don't let somebody move on that. You're going to have a vacancy, and not to mention, if the carpet, the paint was fine for the tenant in there, if you move out, you may have to paint and carpet just to get the house back in a marketable condition. Okay, so all those things, not to mention a mortgage, you may have a mortgage payment or two trying to, one, get that work done and then get the property refilled. So vacancy can cost you a lot. Just repairs. I don't care, even if you have your tenant responsible for minor maintenance and things like that, you're still going to have repairs. And when a tenant moves out, there's going to be a lot of repair items that they didn't necessarily feel obligated to fix. And either way, you still have to get it fixed before you have a marketable property again. So lack of urgency. See, a lot of people just basically, I can't afford to pay a contractor, so I'll get around to do it myself. Okay, I'll get to it this weekend. This weekend the kids got soccer, blah, blah, blah. Everything's get pushed off. Anyway, there's a lack of urgency to get things done. Time costs money with these things, and you gotta act like you got a flame under you-know-what to take action and get the things that need done quickly, and quit wasting time. So, a little story, not fixing what needs fixed. I bought a property, it's been several years ago, but it was, as a guy perspective, there's nothing wrong with the house. All the walls are there, everything works, but the walls were, in the different rooms, were kind of like pastel-y colors, and it just really wasn't marketable. So I let the house sit, and finally it was kind of when I was removing myself from that position, and basically, my wife looked at the house and said, dummy, nobody likes those colors. She had the house painted, and she filled the house in basically about a week and a half. So not fixing what needs fixed can often cost you a lot more than the price of actually getting the house, in this case, the house painted on the inside. And it was really just a couple of rooms that had these funky colors. So another thing, free isn't always free. Somebody may be willing to do a no money down deal with you, but the challenge is they're not going to do that deal unless you're providing something that they can't get done on themselves. And usually there's some type of a problem with the property. Maybe it's just their inability to market it. Maybe it's their inexperience. Again, they were maybe too cheap to hire a real estate professional to market their property. There could be a number of reasons, but you'd better have that skill set that is lacking. Okay, if the property I just mentioned prior, this house was on the MLS. Maybe it didn't sell for the same reasons. Okay, maybe a real estate professional should have told him, hey, maybe, based on feedback, nobody seems to like that color. Maybe we should paint that. It's your responsibility to figure out what the problem is that needs solved. And it's not always just offering fancy financing on the back end as a means to kind of oversight what the obvious, the 900-pound gorilla in the room, or what problem really needs fixed. Okay. Big one, not having a reserve account. Just because you have, a payment spread in what you pay and what you collect doesn't mean you can spend all that money. Especially early on, you should be putting the bulk of your monthly cash flow into a reserve account until you have probably an absolute minimum of 3 to 6 months for every property. And if you've got less than 5 or probably less than 10, that's a pretty good rule of thumb, because any vacancy has a pretty big impact on your bottom line on any given month. As you get bigger, you may feel the need to have less of a reserve account because you have enough cash flow from other properties that even a cluster of vacancies aren't going to take you out of the game. So spending your reserve account. Okay, the reserve account isn't a toy fund. Okay, it's not there to provide fun and exciting things for you in your life. It's there to maintain your assets. It's there to make mortgage payments when you don't have any rent coming in. It's there to replace dishwashers and stoves and roofs and things like that when they wear out. Now, you may have an insurance policy, you still have deductibles, things like that you need to have cash there to protect yourself. And it may get to the point, it may grow to the point where you have so much money in that reserve account it annoys you. Ask me how I know, but you don't want to spend that money. You need it when you need it, and you're not going to know when you need it until you do, and then it's too late. So, you really need to understand the real math. You need to understand reality. And just the example here, if you've got an $800 payment on a house, you're getting $1,200 a month rent. That doesn't mean you got $400 a month in cash flow you can just squander. Okay? You need to be a business person. You need to act like a business person. And let me just I whipped out the calculator here. $1,200 times 0.75 is about $900. Okay, I took 25% off the top to basically come up with a maintenance fund. So we really only have $100 that we can squander should we want to. And I would say $100 isn't going to make or break a change in your life. So put the extra money into a reserve account at minimum until you have a 3 to 6 month reserve. Okay. All right. Let's talk about lessons we've learned from subprime. Okay. Why did we have a collapse in real estate due to subprime financing? Okay. Ultimately, it was a bulk of bad debt. What made it bad? Primarily, we had an inflated interest rate for the first 2 years, and then we had an unrestricted variable rate thereafter, meaning after that first 2-year period, maybe it was 3 years, but most of the ones I saw were about a 2-year loan, and it could adjust to any point after that, which could be several $100 variable in a monthly payment. Now, I guess to offset that downside, it was sold to the person getting that loan as, don't worry, after 2 years, we'll just refinance you and we'll get you into a different loan product. So it was kind of a revolving door for the mortgage broker. Sounds like a pretty good deal. Okay, but what happened? Okay, we had those balloon date changes came, the market collapsed, houses weren't going up in value, houses weren't appraised, they no longer had that refinance as an option. And invariably people couldn't make their payments and they lost the house to foreclosure. So again, was it an equity problem? No, it wasn't an equity problem. It was a payment relative to income, assuming we're talking about investors that took on subprime debt. Okay, whether they qualified for them, whether they assumed somebody else's loan, whether they took another subprime loan subject to the existing loan, or maybe even they did a lease option with an owner that had a subprime loan. And I've seen this before, where just because you're making your payments as a tenant, as a master tenant on a sandwich lease option, doesn't mean the person is actually making the mortgage payment. If they start losing a ton of money, they may decide, hey, I don't need this thing. And they're not going to tell you. They're going to keep collecting your check. And then at some point, you're going to get a notice, or your tenant who's occupying the property would get a notice and say, hey, I've got this foreclosure notice. What's up with that? So, again, a balloon date or a change date on the loan, which allowed the loan to modify drastically the interest rate, which again really affects what monthly payment is there. Negative cash flow issues. A lot of investors took on negative cash flow because houses were going up in value. And they could basically justify it by saying, hey, it's only costing me $200-300 a month. In a year or two, I'm going to make $50,000 because this house is going up in value so much. And that sounds great, assuming it's all going up in value. If something doesn't go up in value, what happens then? Is it still a good deal? And the reality is we know the result. We know the answer to that question. So Negative cash flow might be a strategy for you. After you're more of a mature business, when you have a lot of extra cash flow coming in, and maybe you can help a seller out of maybe it's a loan that they can no longer afford, and they're willing to trade equity for an investor who would take over the loan and take on that negative cash flow. But maybe at that point, maybe it costs you, just as an example, for $200 or $400 a month negative cash flow, you're getting double that in pay down on the loan. Maybe you're getting triple that in pay down on the loan. Those are things that mature investor who understands how to work a financial calculator can work the math. Is this a good deal for them? And is this a good deal for the long haul based on their situation? Is that a good deal for an investor who's just getting started? Absolutely not. Everything needs positive cash flow. That's a game you can play later once you've made it. So anyway, it's all good. Subprime was all good as long as real estate was going up. But again, once it didn't go up, bad things happened, and you don't want to be the last person in the pool when the market is collapsing and you've got bad debt on the property. So one last note: management versus maintenance. When you hold a property short term, not a lot goes wrong. It's probably going to look pretty similar in 2 years that it did when you bought it. So well, that was clever timing on the phone, huh? Wonderful time to get a call from a politician trying to sway my vote. All right. Again, if you're holding a property for a short term, you're probably not going to have a lot of major maintenance items. You're probably not going to have a lot of management items. But when you start looking at a longer term hold, you're going to have vacancy issues. Okay? Over time, you will have a vacancy expense. You will have to replace items. Things are going to wear out. Okay, you will have ongoing management, and those things are going to increase over time. And it all boils back down to the fact that, $400 a month difference in your PITI payment and what the house rents for doesn't equal $400 a month in spendable additional income. And that is the important thing you need to understand when it comes to a monthly, the monthly spread. So you gotta have reserves. You gotta have that nest egg to cover those items when they wear out or break. Or you're eventually going to probably have one of those rentals that I buy as a wholesale or a fix and flip property where it was rented and rented for years and years and years, and slowly little things, deferred maintenance items did not get repaired to the point where now it's a $30,000, $40,000, $50,000 rehab project, and the property owner doesn't have that money to fix up the property. And then ultimately that's what the situation looks like when I'm the wholesale buyer. So don't be that person, okay? Learn how to manage your assets. Hope you enjoyed the video. If you want to leave a comment, we definitely appreciate your comments. And basically, if you come across a new and exciting way that I neglect to mention in the video, I'd love for you to post it as a comment below. The idea, again, isn't to teach you how to screw up and lose money, but learn from the mistakes of others so you don't have the benefit of sharing one of those this is how I lost my ass at story. So cheers, everybody. If you want more exciting creative real estate investing training, check out my website localmentor.com and sign up for my free course on how to thrive in today's exciting real estate marketing. Okay, exciting wasn't in the title, but since that's the title for today, we're going to call it exciting. So boom, I am out of here. Leave me a comment, give me a thumbs up, interact somehow. Have a good one, folks. This is your local mentor, Michael J. Have a great day.